Similar to any typical employee, does the Indian government practice saving money and making investments? Indeed, even the central government follows this practice. Were you aware that the Finance Minister of India releases the budget annually? Typically, government concentrates on specific sectors when preparing the budget. To identify optimal investment prospects, it is vital to comprehend how the government acquires and allocates funds. To do this, it is essential to grasp the flowchart of the budget, which comprises various components. This video provides an in-depth exploration of the budget and its constituent parts. Government budget is divided into two parts: revenue budget and capital budget. A revenue budget refers to the financial plan laid out by the government that outlines the expected inflows of funds and proposed expenditure for the upcoming fiscal year. Main focus here is the welfare of people. Capital budget means a budget allocating money for the acquisition or maintenance of fixed assets such as land, buildings, and equipment. Here the main focus is to grow GDP. Revenue budget is further divided into revenue receipts and revenue expenditure. Revenue receipts is the income part to the government that is recurring. This component has an impact on the profit and loss section of the income statement. It is further categorized into tax revenue and non-tax revenue. The term revenue expenditure refers to any money spent by the business that covers short-term expenses. This means the money is used for expenses that are used within 1 year. Revenue expenditure is further divided into planned revenue expenditure and non-planned revenue expenditure. Planned revenue expenditure is essentially the budget support to the central plan and the central assistance to state and union territory plans. Some examples are energy expenses, communication, and transportation. Non-planned revenue expenditure is obligatory in nature, like interest payments and pensions. Capital budget is further divided into capital receipts and capital expenditure. Capital receipts are those receipts which either create liabilities or reduce the asset value of the government. They are basically the loans raised by the government from various sources to fund long-term developmental needs. They are non-recurring in nature. Capital expenditure is money spent by the business or organization on acquiring or maintaining fixed assets such as land, buildings, and equipment. Capital expenditure is divided into planned and non-planned.
Control.
Planned capital expenditure is budgeted or projected outlays for major expenditures on permanent or fixed assets as outlined in the corporate financial plan. Non-planned capital expenditure include loans for public goods, loans to other states, and loans to other countries. Hope you got a basic idea on how budget is structured into different components. Subscribe to Eagle Finance for more financial content like this.